Hello and welcome to SBI Presents India Revival Mission eForum, presented by State Bank of India, co-powered by LIC and Punjab National Bank. Now, this is a very special initiative that we at the Times Network have rolled out, which is looking at how the economy of this country is looking to revive, reboot, and relaunch now. As we all know, the country is recovering from the pandemic-induced lockdown, and green shoots of growth are being witnessed all around. In fact, in its recent policy statement, the Reserve Bank of India has forecast a 10.5% growth for India for FY22. And with the rollout of the COVID-19 vaccine, even the Indian consumers are looking upbeat about the future along with corporate India. A recent CARE Ratings banking review report of January 2021 also shows that bank credit growth has been mainly led by the increase in retail loans. So today's very special panel discussion is focusing on the thought of how growth outlook for consumer confidence and retail loans will be brought about. Because for the economy to fire, it is very important that consumer confidence and consumer consumption comes back on track. And I have a panel of experts here today with me to discuss this very topic. Allow me to first introduce my panelists. We have Ms. Saloni Narayan. She's the Deputy Managing Director, Retail Business at the State Bank of India. We have Mr. Sumit Bali. He's the President and Head of Retail Lending at Axis Bank. Mr. Sanjay Agarwal, the Senior Director at CARE Ratings. And also Sanjay Doshi, Partner and Head Financial Services Advisory, KPMG in India. Ma'am, gentlemen, thank you so much for joining me. Some consumers to get their hands on these products. I'll come to Mr. Agarwal. So one important part, and what Mr. Bali was also talking about, that they're digitizing so that the loan process becomes easier and quicker, and Ms. Narayan also spoke about that. One important part that kind of got impacted is an individual's credit ratings. Because of the lockdown, obviously the government did talk about the moratorium for the loans. But I'm coming to a very basic question, because there are very often people who just say, what is this importance of this credit rating? Why does it matter if I pay my credit card bill a little later, or if I miss one EMI of my loan and pay it a little while later? Just wanting to get your inputs on the focus of why a credit rating is important for a consumer.
So if you see the various schemes that various banks and lenders have now been introducing, there is a lot of focus on the individual credit bureau scores, because that becomes sort of a cutoff. One is for deciding whether to take in the credit or not, and two is for giving the sort of interest rates and other benefit that the consumer would want from the lender. So in that sense, these credit bureau scores have become very important, and maintaining those scores becomes important to the borrower, so that he can borrow more, borrow at much easier terms, and borrow from a much larger variety of lenders. So it's all about whether you want a choice, or whether you want to surrender the choice for some reason which are within your control. And if you see this pandemic, credit bureau scores have been very important for maintaining the asset quality and the lender-borrower relationships. Right. Because people are very aware of credit bureau scores now. So this credit rating is important to the individual, and that has helped us tide over the pandemic, unless when we saw the global financial crisis way back in 2008, where in some cases unsecured personal loan of some of the institutions went down by almost 80 to 90%. Now we see the percentage is much more reasonable, and wherever the payments are not being made, there are genuine concerns. And now both the lender and the borrower, along with the support of RBI and others, can sit down and try to mitigate the situation rather than be forced to take a strong decision one way or the other.
Absolutely, that's most important in that point. And I'll come to Mr. Doshi now.
Get an idea of the stress coming on to those entities in the next year.
Absolutely, right. Mr. Agarwal, I think you wanted to make a comment on that. And ma'am, I'll come to you as well.
Yes, so as Mr. Bali said, there are multiple issues out here. First is the stress is higher on the unsecured and personal loan portfolio rather than the low yield home loan and CV loan sort of a portfolio. So that portfolio is able to absorb some of the stress. The other thing is banks and institutions have been providing since March 2020 on COVID provisions. So that will absorb some part of the stress. The third thing, as Mr. Bali said, this is very institution specific, and the asset segment the institution is and the yield curve of that asset segment the institution is, which will make a difference. So these are the very large points which will help absorb the issues out there.
Fantastic. Very valid point there, Mr. Agarwal. In fact, that was going to be my next point, which I was going to take ahead to Mr. Agarwal, is this part that, the generation before this generation was loan averse. They would always speak about, whatever you have, जितनी चादर है उतना ही पैर फैलाओ. So whatever you have, live with that. Don't look at loans. But this new generation is open to taking loans, getting things on EMIs. Is this also a shift that you are seeing in the way ahead when you are looking at the entire space?
Yeah, so that certainly the figures that we are seeing, the loan growth and GDP, loan to GDP growth, those figures are inching upwards, though it's a slow process. They are inching upwards. The other thing, Saloni ma'am and Mr. Sumit did not touch upon was the informal lending sector, which is not captured in the data point. So in some categories, let's say the gold loan, etc., those data points are very strong, whereas for mortgages, etc., it's weak. But in some categories, it's very strong. So we expect that as the digitalization and the customer experience becomes much and much more easier, and the various initiatives government has been taking over the years, such as the JAM scheme, etc., this whole system will get more formalized, and it will be easier for the borrower to borrow or the customer to consume, and hence borrow as he or she required. So there will be a few things which will work along with the demographics, which should help us in improving this figure.
Fantastic. Mr. Agarwal, you were wanting to make...
Yeah, so what Mr. Doshi has said correctly pointed out was there are two uses of the card. One is the payment and other is the credit. So as Mr. Bali had captured the payment part of it, even in credit, you see huge amount of fintechs which have come in. And now the banks themselves have, practically every bank has a fintech within itself, and they have been very successful in launching the buy now, pay later, those short-term loans and unsecured loans portfolios. And those portfolios are now pretty substantially large. So what 10 years ago would have been captured entirely by the credit card market is now distributed amongst various platforms. So probably the credit card growth may not look high, or the figure may not look very high, but the market certainly is evolving, and it's evolving well, because it also offers a lot of opportunity to the lender given the high rates of revolver, etc. So there's a lot of cushion out there. You also have consumer durable loans and all that. We have a lot of cushion out there. So that will evolve in the market.
Okay. Go ahead for the economy, for the country to keep moving and get out of this slump. Finally, Mr. Agarwal, coming to you as we close the panel, just your closing comments, your thoughts.
Yeah, so as ma'am has said, the digitization journey has picked up steam. We have seen significant businesses move entirely algo-based and straight-through processing. So this processing pace has increased. I mean, today we see home loans, probably 20-25% of the entire home loan basket in India is going through at least the approvals go through state loan STPs. So that will increase since the corporate book is not firing as of now, so the competition on the retail would increase substantially, because banks and NBFCs have to focus on that segment. That is what also the equity investors want. As a result, the customers would be spoiled for choice. However, the issue would be in terms of the customers taking precaution for their credit scores and the credit standing. So those with a very good credit standing would get very good offers. Those which are weaker ones, because in COVID we have seen that the weaker segments are the ones which fail significantly. So the weaker ones will have very much lesser choice and probably a bad sort of a taste. So I think these are the few trends which will remain. The growth obviously will follow the GDP growth, and lockdown, unlock, all those things will happen. But I think the trend today is what is likely to stay for some time as we go ahead.
Fantastic. Well, thank you so much for coming on this panel. Thank you, Ms. Narayan. Thank you, Mr. Bali. Thank you, Mr. Doshi. And thank you, Mr. Agarwal. It's been a fantastic discussion, very insightful. And I hope the audience, you are taking back some key pointers that our panelists have made about the fact that, yes, growth is there. It is a good time to manage to take up loans if you require it. Obviously, plan properly. Use the digital medium to the best, because the banks are out there to help us with this digital medium to reduce the paperwork, reduce time, most importantly, and provide ease of access and ease of reaching out. You've been watching SBI Presents Times Network's India Revival Mission eForum, co-powered by LIC and Punjab National Bank. Thank you so much for attending and watching. Thank you.